Yeah, that Friday daily bar, not great. Let's take a deep dive and see what it implies if markets are really that damaged and build a game plan for the upcoming week's worth of trade. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we're certainly dealing with a solid red-bodied bar, not a whole lot of upper or lower wick to read into from a psychological perspective. We did close fairly weak towards the lows of the weekly range, so structurally, yeah, the sellers do get a little bit of an upper hand here. But if we think about location on the bar-to-bar count, we did produce a significant higher low and an equal high. So was there really that much progress made in the downward direction? I would certainly argue not really. If anything, starts to pan out as an inside bar. We would typically classify this as a 3-bar play setting up. So bar number 1 is an aggressive trend bar. Bar number 2 is some sort of consolidation above the 50% mark of that trend bar. And bar number 3, perhaps, if we break those highs, looks for continuation in the upward direction in a bullish 3-bar play setup. So not overly concerned, especially if we also factor in the size of this candle body. It's nothing like the panic selling that we've seen in the past. Even the SVB breakdown bar back here was far more aggressive than what we've seen the past 2 weekly red bars that we've gotten. So I'm not overly concerned about a big breakdown coming yet. Also, when we pair that with the fact that we know that we're still clearly in an uptrend, right? We have lows, higher lows, higher lows, higher lows. We can still afford to find higher lows really anywhere above the breakout point of this pattern. We've been talking about it for quite some time. It's closer to SPY 420. So will there be a downdraft perhaps if we break these equal lows in here? It's possible, but it's not really a threat for changing the daily trend. As we know, we can take a look at a couple of indications. Volume profile will be up first this week. Is it logical that we're running into a known area of resistance? Absolutely. It's a high volume node, and we've backed off of it a couple of times now. I would also start to remind you that the more times you make precise and equal highs, it could be likely that we need to break and repair those highs before actually moving lower. So if the 3-bar play does pan out, it would actually remind me of something we had very similar towards the top of 2022. Remember that we had all of these equal highs. We needed to break the highs before making that rotation lower to essentially clean up all of the lingering orders that were perhaps up and above that level. So something similar could happen here. I'm not arguing that it needs to happen that way, but it's some concept to certainly carry forward into the coming week's worth of trade. What else can we put on here? Of course, the anchored view apps continue to be not really in play. I suppose the March low anchored view app from the SVB breakdown is starting to provide confluence more so with that area for the weekly higher low. If we take out the Fibonacci's from here up to here, we know that the 38.2 is still stacked around that 420 area as well. So weekly time frame chart, even though we saw a pretty aggressive down day, or reversal I should say, intraday on Friday, didn't really do all that much damage in the grand scheme of things. On the daily time frame chart, let's first evaluate the expected move. If you're not familiar with this study, check out the tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 444.48. That's a lot of 4s, and that, of course, would produce an equal high to these areas in here. So that strikes me as neutral, of course. And if we're contained by the lower bound of the expected move, the number is 432.70. Technically speaking, it is a nuanced higher low. I would start to just classify it as being in the realm of an equal low. So a little bit of a neutral weekly expected move here. It doesn't really strike me as having an overbearing edge either in the upward or downward direction. Of course, if we think about the trend, we know that we're still in an uptrend with lows, higher lows, higher lows, higher lows. We can still afford to find a higher low if we respect Thursday's low of last week. That would certainly be constructive in the upward direction. Friday's bar certainly wouldn't suggest that it's an extremely high probability, but as we move forward, as long as we're above 436.75 on the daily time frame chart, looking A-OK for a higher low. We'll also see this on the hourly, and I'll just remind you of the inverted head and shoulders breakout point, right? So we'll get to that in just a moment. I would also point out before we get to the hourly chart that we've closed the PCE gap up as well as the Thursday gap down from the NFP that was based on the ADP private sector, right? We closed both of those gaps via the move lower on Thursday and then via the leg higher in the initial part of the day on Friday. So no more gaps to really contend with. I would also remind you that this is not going to turn into a double top until it does, and that simply means that we need a lower low underneath the neckline of that double top before a larger breakdown could potentially unfold. That was kind of what we were alluding to on the weekly time frame chart, and that's where the deeper pullbacks on the weekly towards that 420 area become much more of a threat. As of right now, as long as we're above 436.75, not the biggest deal currently. One thing that I would just encourage you to keep an open mind about is the possibility for this to, instead of turning into a double top, what if it turns into an ascending triangle? So we hold Thursday's low, we consolidate into the wedge, and then we break out over time. It certainly is a possibility. Neither of these patterns will be confirmed until, again, we can break the ascending triangle top or the neckline of the double top, right? Either way, we need some sort of confirmation of the pattern. It's just an alternate way of looking at the price action that we have in front of us. We do have to be thinking about the downside risk, of course, with the Friday reversal. So let's take a look at the hourly chart and see what else we can learn about the price action here. So really strong and steady grind higher in the earlier stages of the Friday session, kind of a short squeeze up and over the Thursday's highs, especially noting that Thursday did produce a hammer candle. That was looking really great. So the fact that we rejected off of this overhead supply here strikes me as being more so long liquidation than anything else. It's like longs, they were catching up, playing catch up, and then anyone who was a new money long up at the top, and then anybody who was a long from back here who wanted out for break even, basically, that to me is what kicks off the leg lower into the Friday afternoon session. If you think about how higher convicted shorts act in this market, higher conviction sellers act, this is not how higher conviction shorts get involved, right? They're not just going to suddenly flash crash things into the close of a Friday session. Usually, you're going to see some sort of methodical trend lower with large institutions trying to beat the VWAP price, right, with constant tags back up to that level. So really, at the end of the day, this does strike me as long liquidation, and the fact that there's a lot of indecisiveness out of the market. This would certainly be much more concerning if the daily trend was down, but as we know, the daily trend is up, and there is still very much so a real opportunity for a daily higher low above the neckline of the inverted head and shoulders. Once again, that level is 436.75. A couple of pieces of confluence, and then I'll give you the game plan, the roadmap, if you will, for the upcoming week's worth of trade. I will, of course, concede that we are underneath the 38.2 as of Friday's close. That's not ideal, but the 61.8 is very close to our inverted head and shoulders neckline. I once again would use that as a line in the sand, and we also get confluence around that area if we take out the anchored VWAP. Oops, excuse me. My apologies. It is not quite at that level. It's rather up around the better recapture. So I'll discuss that now, actually. So what is the game plan? If we remove the fibs, there's really not a lot to do in here. We know that the market didn't really have an easy time navigating that area. It was big move down, big move up, big breakout, and then back to it, right? So not a lot of conviction in this area in here. I would want the market to resolve this area. I would give the bulls an edge as long as we're above, again, that level. It's the daily high or low, perhaps, at 436.75. But buyers do build a little bit more of a constructive edge. This is where that anchored VWAP comes into play, right? If we can get a higher low back above 439.75. That is the Thursday high, the hammer high that kicked off the big breakout in the first place from Friday. So in here, neutral with a slight bullish edge. Buyers gain much more of an edge with a higher low over 439.75. We'll look to make some upper targets, 442.50, and then the upper edge of the weekly expected move, 444. In the downward direction, I would only be thinking about not just a break of the 436.75, but it must produce a lower high underneath for me to have a stronger sort of inclination to want to go short this marketplace, right? And the reason behind that, as we'll see in the internals, is once again, I'm not really thinking of these sellers as yet. Maybe it turns into more, but not right now. They're not higher conviction shorts, and we'll see that in internals. Let's just take a look at them now. So here they are. There's a video tutorial in the top right-hand corner if you're not familiar with this screen. But overall, once again, do we have stronger conviction sellers on the breakdown from Friday? Absolutely not, right? If we look at the internal specific to Friday, volume flows are actually approaching positive in the significant direction, up around positive 300 million. Net on the week, we're basically flat after undoing a lot of damage that was done from the Thursday route that took place. Don't get me wrong, this was some substantial selling on Thursday in particular, but once again, the reversal into the close there, it leads me to believe that nobody really has any stronger conviction in this market. And if we just roll back sort of our layers of analysis, we fall back to a daily uptrend, a weekly uptrend, and as we'll see throughout some more evidence, the risk on posture of the market still remains as well. That's why I'm kind of saying, hey, the buyers have an edge as long as we're over that inverted head and shoulders neckline. But in the grand scheme of things, the whole Thursday-Friday interaction strikes me as a big lack of confidence in both directions. Let me be very clear about that. If buyers were stronger, obviously the Friday breakdown would not have happened in the first place. So I'm not trying to overhype the buy side of the market by any stretch of the imagination, but the internals would suggest that there was more solid volume inflows as opposed to outflows. Same thing with the advanced decline line. We get this really over-correlated read on the Thursday session. Remember that whenever we're underneath trend lower zone, those are really unsustainable readings. So Friday, early in the session at least, strikes me as being a correction to that over-correlation. Then the breakdown into the close never gets anywhere close to the zero line out of the advanced decliner. So once again, more so liquidation break as opposed to widespread panic, sell the market, more methodical selling, larger players selling the market. The other thing I would say about the breakdown from early on the Thursday session is that this was long liquidation, right? That was a concept I mentioned on the SPY hourly chart, but look at what the cumulative tick does, right? Makes this big move lower and then it actually flattens out. Whereas a more solid sell side read would have the opposite shape like this and get stronger into the close, right? The same thing, but inverted, takes place on Friday, where we do see a solid build into the high of day. Then it's a mild, small roll, if you will, into the afternoon. It's not that we get something that does this and then this into the close. This would be much more indicative of short squeeze, but that's just not what took place in the market based on the internals. You can clearly see a solid little uptrend here once again across the exchange as a whole on Thursday. Even as the market was selling off, steady improvements were being made. So long liquidation, not outright sell everything, panic, get me out of everything. No, there was some decent improvement there. So once again, the dashboard here would strike me as stronger sellers not getting active, at least yet. But also, again, don't get me wrong, the buyers didn't really hold up all that well into the close of Friday. Obviously, the internals underpinnings, though, would suggest that it might be a little bit stronger than what meets the eye here. Let's continue along. Market profile is always Exhibit B. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Let's keep it simple to start. Overall, the value area from Thursday was where in the profile, as was the point of control. Definitely higher in the profile as we produced that daily hammer candle. Then if we compare that to what took place on the Friday session, value is actually overlapping to up. And the point of control, it's very nuanced, but it is technically slightly higher from the day-to-day session read. Now, don't get me wrong, on Friday, value did not migrate higher in the individual profile. So that's a slight cause for concern, but did the point of control close dead on the lows? Absolutely not. So once again, it's sort of this mixed bag of data points right here where there's not a lot of conviction from either side of the trade, but again, roll back to the daily trend and what's going on here. Overall, the buyers still remain somewhat in control structurally. So unless there's a larger deterioration, I wouldn't look at these very minute shifts of like lack of follow through to the upside here with value area as this big Armageddon-like indication. As a matter of fact, we actually have a poor high on the Friday session as well. Once again, speaking to long liquidation, right? You have longs trapped at the top here. You can actually see this little volume bump. And if those start to close out, those longs start to close out because they're not getting that follow through, that's what creates the poor high in the first place, right? So technically that could use a little bit of repair. If we come back up and tag it, we should expect it to break. Then we'll look for follow through up and over the weekly string of equal highs. One thing that I want us to at least remember, is if we come back here, we do have a poor low from quite some time ago. This is 628, and that level in the ES is right around 4,400. That should be something to carry forward, especially noting that we have thinner-ish structure here from the break that really kicked off this move in the first place. So just remember that in the ES, 4,400 could potentially be a downside target if we do really start taking out this Thursday low and start trading underneath the neckline of the S&P inverted head and shoulders. Jumping back on over to the platform to evaluate the weekly performance of our sectors shows us that real estate led the pack here up 0.67% and healthcare was down at the bottom of the barrel down 2.53%. Just remember that healthcare is technically D for defensive, but it's also the second heaviest weighted sector for the S&P. And in my belief, it's one of the reasons why we were down so big on the reversal from Friday's session. We'll get to that structural chart in just a moment. But speaking of risk on versus risk off, XLK risk on sector, the heaviest weighted sector, it's still down. It's still red, don't get me wrong, down 1.5%, but as we'll see, it's still hanging out right towards those all-time highs. There's a very real opportunity for a daily high or low as well. Same thing with XLY for consumer discretionary, and the XLF is actually building out a pretty solid daily looking pattern. We'll get to that in just a moment. Let's take our tour now. Real estate, what do we see here structurally? Breaking out of the range in the upward direction. Could it have something to do with seasonality? Absolutely. If you talk to local realtors, I'm sure you'll also hear that inventory is drying up, and it's drying up fast, sending prices higher. Lots of cash offers, multiple offers over ask, right? So that type of phenomenon still exists in the real estate market. Just remember, it's a lightweight sector, so upward pressure is upward pressure, but it's not going to make or break your S&P. Next up, XLC, definitely heavier weight and has much more of a closer tie to risk on. Is there any threat to this chart right now? Not really. I mean, Friday's bar, don't get me wrong, isn't the most convincing, but think about the daily trend, think about the weekly trend. Is there an opportunity for a daily higher low over 64.30? Absolutely. Is there a threat of a double top? Yes, but it would really have to take out the neckline, as we've been saying, which is around 63.50 on the XLC. So not overly concerned. Again, even as the market's pulling back structurally out of the sectors, the posture remains fine out of something like communications, utilities. Any leadership here? Absolutely not. It was green on the week, but again, it's not really, sending prices up and over this prior pivot top around 70. It's also not threatening a big breakdown of these equal lows. I mean, could it get there in the coming weeks worth of trade? Yes. Remember, we don't want this falling off of a cliff, so we'll make note when and if it breaks down through these lows, but we're just not there yet, right? So the biggest takeaway for the market right now is, sure, there's a reasonable pullback taking place off of an equal high, but posture-wise, are there any threats? Not seeing them currently. Here's the XLV. So D for defensive, breaking down from this balance range here. Remember that we're in a longer-term balance as well. If I just open this up to a multi-year chart, you'll remember that this is kind of our multi-year range, and we're really still stuck in the midpoint of that range. Now, I don't just want to be pie in the sky 90,000 foot view. Don't get me wrong. As long as we remain underneath 130.25, this will be bearish drag for the S&P. But is it happening in a risk-on sector? The answer is no. If there is any sector that wants to see more of an aggressive breakdown, it's probably the D for defensive sectors, and XLV is the heaviest weight D for defensive sector. So once again, really, in my estimation, has a lot to do with the Friday route, and posture-wise, it's not really a threat based on what I can see at least. So sure, downward drag, but posture-wise, not a massive deal. If we look at something like the XLB for materials, lightweight sector, kind of in the midpoint towards the upper portion of this range, if you will. You could also expand the range and just say that we've really done nothing over the past little bit here. It's a lightweight sector. It won't make or break the S&P. Sure, there's an opportunity for a head and shoulders here if we produce a lower high off of the 82 rejection, but just remember, you got to break down through that neckline. And even at that, it's slight downward pressure for the S&P. XLK, this is where things really matter here. So just as a reminder, all-time high, basically right at all-time highs. If we zoom in a little bit, don't get me wrong, yes, there is the threat of a head and shoulders, but you've got to break the neckline, or if it's going to turn into a double top and you want to use horizontal levels, you've got to get underneath the neckline. So what's the key watch into this week's worth of trade? 167.65. That's the level. If we're above it, posture-wise, no big threats. If we're underneath it, yeah, absolutely. There's an opportunity for a deeper weekly pullback, but if I just go to something like a weekly time frame chart, is it not unreasonable that the XLK could consolidate? It could do something like this, build out a weekly bull flag, and then break into the future at some point? Absolutely. So unless there's Armageddon type selling underneath 163.65, I would have to say posture-wise, it still strikes me as strong. Again, intraday, as we're trading the S&Ps, could there be some adverse reactions? Could this help some downside trades if we're below 167.65? Absolutely. I'm not arguing, against that, but I'm just saying posture-wise, the threat that the market is just ready to crumble and go to zero, I'm not seeing it with evidence like this in front of us. Let's take a look at the XLY. What's going on over here? Very similar in terms of concept. There's your bull flag. We're above it. As long as we're above that level, 167.25, it seems like the 67 is the magical number so far. As long as we're above that this week, again, no larger issues from a posture perspective. Friday's bar, don't get me wrong, it looks not great in both the XLK and the XLY, but if we can hold the 167.25, no larger threats unfolding, right? And certainly for it to turn into a head and shoulders, I'm sure someone's going to mention it at some point, right? You've got to get underneath that neckline, 163. If we're under that, then absolutely, you'll hear me change my tone, but we're just not there yet in many of these charts, right? We're still dealing with uptrends in all of the heavier weight risk on sectors. Here's the XLP, another reason why the market sold off so aggressively on Friday. You can see that this one was down 1% on the individual day from Friday, but also back down underneath that 74 pivot. It was really sloppy through it in here. I'm not even really convinced that it's the cleanest level to be watching anymore, but nonetheless, is this defensive or is it risk on? It's definitely more defensive. So if there are any sectors that are really deteriorating, the sectors we want to see deteriorating are the ones that, are basically breaking down. If we look at something like energy, any leadership here? Absolutely not. D for defensive, not a big threat for markets. If we look at the XLI, definitely, sides more towards risk on in terms of economic expansion, right? You talk about infrastructure and things like that. It looks great. It's over the top of this range in here. We're coming into the measured move target, which is 109. We're hanging out towards all-time highs. Daily opportunity for a higher low here above the 105 level. Again, don't get me wrong, Friday's bar, not all that convincing, but nonetheless, structurally, we're still in an uptrend. Hard to say anything bearish about the chart here. Let's take a look at the XLF. This one is certainly worth spending some time on because I want you to draw the parallel between what took place on the SPY weekly time frame chart. In previous videos, we'd been talking nonstop about the ascending triangle, and it's almost happening here as well, right? So hard to be a bear in financials as we're continuously building out higher lows. Don't get me wrong, it would have been better to stay above once the recapture of the 200 SMA was on the screen, but we're also, once again, are we making a lower low? Are we underneath that 3285 level that we discussed in prior episodes of the weekend update, midweek market update? No, we're above it. There is an opportunity here for a daily higher low. We will change our tone if we get more firmly back into this range and it builds out as a sideways consolidation, meaning that we test the lows. We're just not there yet, right? We're not there yet. And again, looking left, we know that we have thin structure here. All it's going to take for financials is a little bit of love, a little bit more acceptance over that 3365. And I think that this move can perhaps happen quicker than some folks may imagine. And that, to me, that rotation between tech and financials and consumer discretionary, that's what's going to keep your uptrend afloat or alive up here at these highs. Here's the sector ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner on how to set it up. XLK, on a relative basis, risk on remains. XLV, we know is D for defensive. Is there a threat for risk off coming in? Not really based on this. XLF, starting to perk up. We're keeping an open mind if we break the ascending triangle breakout point on the structural chart, that this perhaps will recapture the descending 50 SMA. It hasn't happened yet. We don't want to overly anticipate that, but we're keeping an open mind to a recovery here out of the XLF financials. XLY certainly looks like a risk-on indication. Closest tie to the XLK, as we know, is the XLC, still above an upward sloping 50 SMA, making a strong little cup and handle on the more micro side of the daily time frame chart. Risk off looks like risk off is off, and risk off looks like risk off is off in utilities. I know that is a tongue twister, but basically the indication is that risk off is not a threat as of right now, with all three of these sectors pointing in the downward direction here in the lower quadrant. Remember that real estate speaks much more to the wealth effect, and we just saw a breakout on the structural chart from the daily perspective. Let's take a look at the XLY over the XLP. Sharp new higher high being ushered in on the Friday session, as I'm likely sure you could imagine based on the XLP breakdown, whereas the XLY was relatively flat. So risk on posture is still very much so alive in the market. Taking a look at the dollar, you can still see that we are well underneath that 103.50 inflection point back here, and Friday actually had a substantial day in the downward direction, which would typically speak to bullish improvements out of equities down below. But if we get more granular and take a look at something like the 15-minute time frame chart, this is important to make note of. When the quote, big air quotes around this, market crash took place on Friday's afternoon session, the dollar itself did not migrate in the upward direction. So that would sort of indicate to me that once again, the liquidation break theory really reigns supreme. There's not some sort of systemic risk or, stronger sellers getting active based on some move from the dollar, from what we can literally see here in the dollar price action itself. Let's take a look at the gold contract and just see if this is confirming any of this activity whatsoever. Let's go on up to the daily time frame chart. We remember 1920 is the key level that we've been watching. The fact that Friday actually closed above would absolutely confirm what we saw out of the dollar, speaking to, once again, the liquidation break theory down below in equities, holding true, at least as of right now. Let's take a look at something like our TNX for the 10-year rates, and there's a really impressive relationship that's going on here. The fact that the TNX has broken out so aggressively from this range, and the XLK has only been mildly lower off of the all-time high pullback, basically, over the last week's worth of trade, strikes me as incredibly resilient. What does this sort of indicate from the market? It's really been pricing in that, yes, we do believe Jerome Powell will be higher for longer. That's fine. The XLK is still going to remain where it's going to remain, even if rates are quite literally blasting out of this range in the upward direction, which in theory should be big bearish drag for the XLK. So this is a really important relationship to continue to keep an eye on. Another interesting thing that we can make note of from the Friday session is specifically looking at the ZT here, which is the 2-year, and I've just inverted it. This is going to basically mirror your Fed funds rate. And it's the fact that we took out this high on the Thursday session, then backed off aggressively, right? We do have a daily hammer from Friday, but I'm really, really curious to see how this level resolves. Are we going to start getting price acceptance above? That would certainly start to be more of an indication that, yes, we're likely going to see 2 rate hikes into the end of the year. Or if we start to back off a little bit here and start to meander underneath that 101 level, just use that for a round number. If we back off of that, it's really more of an indication that, okay, we may have just topped out here from a rates perspective. Speaking of, let's take a look at the tracker tool. Markets have basically cemented the idea of another 25 basis point rate hike for the next meeting, which is scheduled for July 26th. That's going to be here sooner than you can blink, which is kind of crazy to think about. And as we've been saying over the past couple of episodes here, it's really the battle between 1 versus 2 rate hikes into the remainder of this year. If we are going to get that secondary hike, it is still looking like November is the proper time horizon to be thinking about. Now, let's get fundamental here for a second and take a look at the jobs numbers that came out in the previous week's worth of trade. The ADP non-farm payroll, the preview basically, came in as a blowout, 497 versus 226 expected. Huge beat. And if you were watching those probabilities on the Fed tracker tool, it was saying, yeah, we absolutely can afford to get another rate hike for the November timeframe. And then on Friday, that completely undoes itself, right? And now we're back down around those like 30-ish% probabilities for that secondary rate hike. But look at the sort of read that we got, 209 from the BLS versus 224 expected. And it gets worse than that. We had a prior revision down to 306, which was underneath the previous expectation, not good. And we also had a revision on the hourly earnings, 0.4, right? So we're coming in at 0.4 on hourly earnings, which annualizes to 4.8, and that's higher than the Fed's target. You know, you got to start thinking about wage price spiral, and you also start to have to think about, hey, if these numbers start flipping negative or even get down into those 100,000 range, right? The Fed's going to get pretty nervous, and possibly, we're not there yet, but these are the beginning signs of, hey, maybe we're not going to achieve the soft landing that we've been pretty, optimistic about for the past couple of videos, right? It's not all the way there yet where we're ready to call for a recession, but these numbers, as they're starting to turn, we have to adapt to the new and upcoming data. One thing that I will point out is that the unemployment rate stayed at 3.6, which was a downtick from the prior session. And if I just take a look at the Thinkorswim chart here, you'll remember that it's pretty hard to stuff the genie back into the bottle. So this blue moving average on your screen is a 12-month rolling average of unemployment, and we're right at it. And in all the other instances where we start to break up and over that 12-month moving average, we know bad things typically happen in the labor market. Once again, the genie is very difficult to put back in the bottle. We're not there yet, but we're right on the edge. It's a reasonable thing to be concerned about as continued data comes out. And speaking of continued data, what we have in the coming week's worth of trade is going to be just as important from an inflation perspective. Wednesday is CPI, right? Big time, looking for how services are doing on this next reading in here. PPI will follow up on the Thursday session, and then we will be getting consumer sentiment and inflation expectations on Friday. A little bit of a speech there from Waller. Not overly concerned about that. Obviously, it's outside of market hours, but CPI, big threat there. Watching to see how this comes in. We, of course, want to come in at or below the forecast here, especially noting that month over month, it is a tick higher, and the year over year needs to start getting closer to that Fed 2% target that we know they're ultimately dying for at this point in time, right? That way they can sort of back off and say, we've done the job. We're going to let the lag effects start to sort of catch up to the market, basically. And then after CPI, right, if we're just thinking about what's in the pipeline here, you better bet it's all eyes on earnings season and whether or not NVIDIA can really pull through with the massive projections that they made in the last earnings call. Don't get me wrong, that's way out on the horizon, end of August, but that's kind of the progression of fundamental catalysts that we have coming in the pipeline. How's the TLT doing from a risk appetite perspective? Certainly brought in brand new lower lows as of the Friday session, which would classically speak to risk appetite being strong and steady down below in equities. Now, that's helpful for our thesis. However, Chris over at Shivako Capital brought up a really good point in his weekend update. I would encourage you to go over there and watch it. But for the most part, if market participants do not want to be involved in US-backed treasuries, basically, because of the deficit and ultimately higher rates, meaning higher debt service on that deficit, really, then of course it's going to be an inflationary relationship when they flock to equities because you don't want to be involved in this. Where else are you going to put your money, right? So this is an inflationary relationship. Basically, you can still have equities inflation, and that probably won't be seen in CPI, PPI, PCE, but at the end of the day, it sort of entrenches the expectations of inflation if we're used to just collecting, 8% as the market has done. It's done better than that this year throughout 2023, but you get the point, right? This is still an inflationary relationship, and this classic, is there a flight to safety going on here? That relationship may not be the most important to watch going forward. So I thought it was a really great point that Chris made, and something that we've been monitoring for the past couple of videos, if you've been paying very close attention, is shorter duration bonds compared to slightly longer duration bonds. So up at the top, we have IEI versus IEF. That's 3 to 7 versus 7 to 10 year bonds. And you'll notice that this did tick higher. So that is certainly slightly fearful of recession, which starts to pair nicely with some of the economic data that we've been getting. Now, once again, I don't think it's an excuse to just go out and short markets. We need to see a deterioration from the SPY trend itself. But once again, could we start to see some cracks in the armor, basically? Possibly. And this is one of those indications. Same thing here with the IEF, so 7 to 10 versus the TLT 20 year. Even shorter dated maturities are becoming more attractive. So people getting a little bit more uncertain about the current economic conditions after this jobs report. And once again, this is the skewed relationship, TLT versus Qs. Clearly, like this, if you just had a blindfold on and weren't looking at these up at the top, would be saying, yeah, everything's fine and dandy. Risk appetite is great. No signs of recession, nothing, right? So that's certainly not the case. And I do want to be very thorough with these two relationships right here. Let's take a look at something like the HYG, because there's a massive negative divergence now. Remember that we had a positive divergence with the higher high, worked out beautifully with this move higher out of equities, but now we've actually produced a lower low in the HYG, whereas the S&P equities have produced a higher low. So it's been wild, it's been back and forth, but if these divergences are going to remain firm, remember that the HYG hasn't lied to us on any of these yet so far, this would certainly suggest that we could see some deeper pullback in equities down below. So as the data materializes, as we continue to get more information from this market, yeah, it's reasonable that our expectations could morph from, hey, we're in a very strong daily uptrend to, okay, it's mildly weakening, maybe the data starts to soften, and guess what? We will adapt with an ever-adapting market. There was no sense in being short up until this point, and there's still no sense in being short yet fully, but you can start to see some of these issues that are arising. Let's take a look at the Bitcoin daily time frame chart. Something to point out here is that there was a failed move up and over the top of this flag. Don't get me wrong, there's no breakdown that's aggressively taking place, but there wasn't really a whole lot of conviction as we started taking out those highs. Remember, at one point, this was a solid green-bodied bar. Why was there no follow-through up and over the top? Remember, not a one-to-one, especially with the normal financial markets down below, but overall, slightly questionable, sort of pairs with the skepticism that we're bringing as we get to these equal highs and potentially looking for more consolidation sideways or even a slightly more aggressive weekly pullback to start to unfold. Market breadth, new highs versus lows, is right back down at the zero line. It's not a great look, but as long as we can stay positive and not start making aggressive negative impressions, I would say it's an okay look for markets. We obviously want to see it improve and stay positive, but this give back to me is sort of within the bounds of what we would consider normal under recovering conditions. You can see what happens here in the early stages after the sickness crash, which we know caused all sorts of mayhem. If we take a look at the SPX A200R, perhaps a little bit more convincing, staying stable, really going sideways up here. That just speaks to lots of stocks recapturing the 200 SMA, and even as the Friday pullback unfolded, not really giving back too much of those gains. And same thing can be said here about the SPX A50R. Remember that this is now a daily time frame chart. We're one-to-one down below. If you look at this prior pullback high, or I shouldn't say pullback high, but breakout high here, we're above it in the SPX A50R. We're technically underneath it in the S&P equities themselves. So is the breadth improving to some degree here? I would have to say yes. So it's not all doom and gloom with some of the more fundamental takes we just had a moment ago. Breadth actually looks like it's holding in there kind of okay. If we take a look at the RSP, which is going to be the equal weight S&P 500, you'll notice that it produced the equal high. It produced an equal high on Friday, and there's still a strong opportunity for a daily high or low, right? If I zoom in on this, make it a little easier for you. The fact that this equal high is on the table, whereas S&P weighted down below did not really get up there all the way for the equal high, once again, has to be somewhat convincing that it's not the end of the world yet. We'll get a little bit more bearish if we start breaking down underneath a double top neckline. We're just not there yet. 145 is still your key watch. If we take a look at the Dow theory, this of course continues to be a bit more of an issue for markets, just noting that transports continue to take off in the upward direction and industrials are not agreeing. The issue here is that the double top neckline is almost in play as soon as we open up on the Monday session. This will be fairly telling. Once again, I was very careful not to omit this in last week's video. Certainly in play. If we break that neckline, I would certainly have to imagine that a deeper pullback across broad markets could start to unfold. VIX volatility still doesn't strike me as a big deal yet. Now, I'm not going to ignore the fact that it did spike a little bit into the end of the week here. However, if we zoom in and look at Friday's session in particular as the big air quotes here, market crash from Friday afternoon took place, did VIX actually close higher and over the opening print? The answer to that question is simply no. Now, again, don't get me wrong, it's still at and slightly holding 15 as support. If it starts to aggressively move higher, we will start to consider that in the analysis, but as of right now, it still supports the idea of liquidation break until proven otherwise. We can take a look at something like the VVIX as well, and you'll notice that even this did not spike up and over the 103 level. It actually rejected that and closed weak on the Friday session. So again, volatility slightly elevated here. It's worth acknowledging, but we're not at points yet where we would be expecting outright, Armageddon type selling like what we've seen in the past over here. If we take a look at the volatility futures for all the purists, yes, we are moving closer to a backwardation, but still that requires being above the zero line, not even close as of Friday's close, right? The 9 versus 30-day VIX, speaking to all the naysayers for zero DTE options, still underneath the zero line here, and what took place out of the one-day VIX on Friday, even as the market, quote unquote, again, big air quotes there, crash takes place, we're still mildly inside of the range of what's starting to become normal for the one-day VIX, right? We really don't have a data set here yet, but if it was going to be more of an Armageddon type situation, you would have had to imagine that we closed somewhere up here. It simply, again, was not the case. QQQ weekly time frame chart. What do we see here from a candle structure and location perspective? Certainly very similar to the S&P, with a small red-bodied bar and not a whole lot of upper or lower wick to discuss from a psychology perspective. And yes, sellers did close weak at the lows of the overall trading range here, so maybe a small bearish edge from a structural perspective, but on the bar-to-bar count, certainly a substantial higher low above the 50% retracement mark of the prior weekly range, and also a very nuanced higher high, unlike the S&P, which only produced an equal high. I'm still leaving it zoomed out so you can just note the size of the candle body here versus larger aggressive selling like what we've seen in the past. It's nowhere even close. We also know that the QQQ weekly time frame chart is in a very firm uptrend with clear higher lows, higher highs along the way, and we know this, right? I hate to be that guy, but technically a higher low could be produced anywhere above 320. Right? 320 could certainly still produce a higher low from here to here. Don't get me wrong, intraday, intra-week, there would certainly be some bearish opportunities to take advantage of, but we're just not there yet, and nothing about this bar currently would suggest larger downside incoming. I would also remind you that we're pulling back and sort of struggling at a reasonable area in the market prior structure here, and if we pair that with a volume profile, we also know that it's a high volume node, right? Beautifully going right through the prior structure, solid area of resistance. And once again, reinforcing the 320, hate to be that guy, but it's a high volume node on the downside. Market could catch itself for support there and do something like this on the weekly time frame. The main point of covering the high time frame on the Qs is just to point out the solid structure, the rounded bottom and constructive look that we have underneath us. In terms of pullback levels from the weekly, we don't really have anything that's immediately in play. Even if we anchor a VWAP to this sort of most recent rally and leg higher, we're not pricing in a move to 340 in the coming weeks worth of trade, or excuse me, that's 330. The Fibonacci 38.2 is closer to 340. If I do something like this, there's your 38.2, that's your 340 read. Even that is not even close to being in play in the coming weeks worth of trade, unless there was to be a massive black swan event, which again, if you're trading in fear of a black swan, then trading is probably not for you, right? You've got to have some sort of faith that markets will proceed and do what they will do. So let's take a look at the daily time frame chart here and just build a little bit more of a nuanced relationship with the price action that's at play. We know that we're in a daily uptrend. We know that we have lows, higher lows. We know that we have highs, equal-ish to maybe the opportunity for a daily lower high here. Expected move on the week is certainly neutral with the equal high suggestion at 373, but a very nuanced higher low from here to here around 359.50 roughly, give or take. What's not great about that, of course, is just the implication that we could fail the neckline of the inverted head and shoulders that we know to be true from the hourly time frame chart. Just like the XLK over in the S&P sectors, you could make the argument that there's this really skewed head and shoulders building out, but just remember that we've got to break the neckline for that to be in play. If you're a pattern trader, just remember that all patterns do is suggest to you where you're going to have a trend change, and we can do that with horizontal levels. So call it a head and shoulders, call it a double top, you could call it whatever you want. Those patterns are only valid when and if we can break necklines, and again, that would require getting down underneath 357.25. The other thing to consider here too, right, is if you're a pattern trader, why couldn't this also be, as we pointed out in the S&P, why couldn't it be an ascending triangle? So don't let your bias control you if you're just kind of scouting for patterns on a daily time frame chart. Perhaps that is useful for someone. We've closed all of the gaps that are around us. So the PCE gap up closed, obviously. Beautiful gap fill reversal on the Thursday session. That was really the trade of the week. And then there's that sharp reversal, of course, on Friday. We can't hide from that. But if we take a look at the hourly time frame chart, What else can we learn about the price action in here? The breakdown from Friday, once again, is still over the neckline of the inverted head and shoulders, so it's really hard to say that the bears have built much more of an edge as long as we're above 364.85. I would say that in here, just like the S&P, we're kind of more neutral with a slight bullish edge because of the daily uptrend. We get much more constructive for bullish outcomes with a higher low over 367.50. That's Thursday's high of the daily hammer candle, right? Obviously, from there, your upper targets become 370.25, and the upper bound of the expected move. Bears, you build an edge with a lower high, not just a breakdown, but confirm it with the lower high underneath 364.85. Any confluence with our Fibonacci's? Let's take a look here. Remember that because we didn't make the 100% retracement all the way up to the top, you could come in from here. It's almost one and the same. I do have to at least acknowledge, right, that the 61.8 has failed to hold here. So in a picture perfect world, you get the 100% retracement the more time you spend above the 61.8. Obviously, again, that did not hold as of Friday's close. Not the end of the world. You are getting some confluence of support with the 50% retracement at the neckline level. Once again, 364.85 there. Let's take a look at the anchored VWAP from the breakout, the head basically of this pattern, right at it as of the close of Friday's session. So once again, I think you need some resolution of this level right in here. This certainly constructive for upside. If we're just neutral in here, it would definitely come with more of a bullish edge, and bears need the proof of the lower high first underneath 364.85. How about the internals for the NASDAQ side of things on last week's worth of trade? Mild inflows, once again, really hovering close to the zero line, nowhere even close to the significant 600 million read that we need on the weekly net. If we take a look at the in and outflows of Thursday and Friday respectively, Thursday was not nearly as bad as what the S&P did, where the S&P breached negative 300 million in a much more substantial manner. The overcorrelation here on Thursday also isn't as bad. Don't get me wrong, this is not great to see, and it still speaks to overcorrelation, but it's not nearly as bad as what we got out of the S&P. So a little bit stronger in terms of the reversal that we saw, or at least the hold at the NASDAQ side of things. You could also make the case, that this is much more indicative of long liquidation. You can see the sharper like this and then into the close like that. It wasn't a sustained build like this into the close. So I do like that in terms of liquidation break, not aggressive new money sellers getting active in the NQ side of things, as well as the tick on Friday doing the flat line, exactly what we do want to see, more of the sustained read, stronger buying, and it didn't kind of evaporate into the close there. So overall, NQ and the QQQ NASDAQ side of things does strike me as being a little bit more constructive and healthier than the S&P side of things, especially with the reflection, obviously, less healthcare in the XLK and just the tech side of the marketplace. What I'm getting at is the XLK was the biggest drag for the S&Ps, and we already walked through that in terms of sectors, right? If we take a look at the NQ in terms of market profile, poor high on the Friday session, just like the S&P. Point of control and value area was higher than the Thursday reversal. We do have a poor high and a poor low from the Thursday session, so is it reasonable? Here's just something to consider, right? Is it reasonable that the market could see a pullback to test Thursday's low again, sweep it and repair this low, and if we come back above Thursday's low, it's game back onto the point of control, looking for follow through in the upward direction, that cements your daily higher low. What would that look like over on the candlestick chart? I want to be very thorough about this as an outcome because I think it's a very real possibility. If this ultimately does lead to a little bit more downside selling momentum, we sweep this low, if we can get, let's get that one more time. If we sweep the low and get a higher low back above, that to me would be a bullish indication. Repair the poor low, respect the structure, trap some new shorts, and then produce the higher low. That would be confidence inspiring back to Thursday's high and then looking for continuation after that. So that's your NQ. IWM Russell 2000 and the small caps will round out the broad market for us, and once again, one of these things does not look like the others. This has produced a weekly hammer candle. Don't get me wrong, we do have a red-bodied hammer, so we did close underneath the opening print up here, but the long lower wick suggests that the buyers were able to step up, and they did not allow for a very weak close at the lows of the weekly range. And also, if we think about location, there's some structural significance in terms of larger chart structure like this, respecting once again the top of this previous weekly range in here for a weekly higher low. So I'm really liking what I'm seeing out of the IWM and the relative strength that's there, especially in comparison to the quote-unquote catch-up that it needs to do to really get back to on par with the other broad market indexes. Don't get me wrong, from a monthly perspective, we're still unchanged in the midpoint of this range, but solid first steps in the upward direction here on the weekly time frame. Let's take a look at the anchored view apps, because you'll remember that on the weekly, this is producing a little bit of a pinch as long as we have support here, which once again is structurally significant, top of the prior range, 179, 180. That does strike me as a solid level of support on the weekly, and we need to breach these equal highs closer to 189 and also break the weekly anchored view app anchored to the all-time high back here. That would certainly start to produce much more of an opportunity for the weekly equal highs getting closer to 200, the top of that monthly range we were just sort of alluding to in here. What else is substantial? Well, if we throw on the volume profile for IWM and small caps, breaking over the weekly balance range that we've just produced brings us to our next overhead structure, which once again, there's 200 and there is 200. So low volume void to travel through, then a high volume node at 200 kind of makes sense in the upward direction. If we start breaking down underneath the bottom, just remember that there's limited downside here, in my belief at least, with this strong volume node underneath us. Really been building out this sideways action in here. It would really require for like a larger downdraft out of IWM. You got to break this and put in a lower high, confirming it as overhead supply, and then that's your Armageddon situation. We're just not seeing it yet on these weekly or even higher time frame charts. Let's move on down to a daily and evaluate our expected move, see what else we can learn about small caps into the coming weeks worth of trade. Expected move is definitely neutral, and the daily chart is kind of maddening to some degree. So equal high, equal low, obviously building out this as your next range really to be dealing with. Remember that on the first attempt here, we were kind of expecting that there was going to be some kind of rejection underneath 184.75 for a daily lower high. When that didn't happen, the next thought was, okay, if we're strong now out of smalls, we're looking for a higher low above, and that also didn't happen. So the 184.75 level really needs some more firm resolution, and at this point, because this is a balance range, whenever we're in the midpoint of a balance, if you've been tuning into the channel, you know that you don't have an edge there. Your edge is at the top for a breakout or mean reversion, and the same is true but opposite at the bottom, mean reversion or a breakdown. 184.75, it's got to do something here to give us more of an impressive look out of IWM. Let's take a look at the hourly time frame chart just to build on any structure that we can see from in here. I would say that the afternoon pullback really wasn't all that bad as compared to some of the other charts that we've seen so far in today's episode, closing right at the 184.75. So once again, kind of a P for patience play. How does this resolve, right? The more time that we can spend above, the more bullish it looks for a potential breakout of the weekly range. If we start drifting underneath, definitely a little bit more bearish. It's as simple as that out of your IWM. Remember that this usually acts more so as a risk on versus risk off proxy for broad markets as a whole. If we anchor to the bottom of the range in this most recent leg in the upward direction, your anchored VWAP is right there. We can even take it a step further and go to 2023, 0703, July 3rd. Take a look at this one. So anchored to the top of the range, the most recent high that we've got. And once again, you're right at 184.75. So overall, needs some resolution out of 184.75. I would treat it very simply into the coming weeks worth of trade. Bullish up here, looking for that breakout, or at least being constructive on the broad market. If we start slipping down underneath, hey, maybe a little bit more skeptical. Maybe we can see those deeper pullbacks unfold out of the S&Ps and the QQQ. If you've made it to this point in the video, I certainly appreciate you tuning into the show. You can let me know down below in the comments section what your favorite cold meal is for the summertime. That way I know you made it to this point, and no, leftover pizza does not count. Let's take a look at Apple daily time frame chart, certainly producing brand new all-time highs very recently. So again, this never gets old. It's hard to be a short in Apple here with an incredibly strong trend behind us. We know that daily higher lows can be anywhere above this zone. 186.65 is the daily line in the sand. The daily bar that printed on Friday is not all that convincing with the upper wick taking out Thursday's high and closing weak at the lows, but let's take it on down to the hourly time frame chart to illustrate anything in here, just like the broad market may be a little bit difficult to trade. The better long convicted trades are higher lows over that Friday high 192.50. The better short trades for the deeper daily higher low pullback to here are underneath 190, which is also your gap close area. Note the gap fill reversal was already strong on the first go around. Let's take a look at Netflix. We'll keep it on the hourly time frame chart here. You could certainly make the argument for a daily double top from this perspective, but just remember that it's not a double top until you flush the neckline, which is way down at 418.50. There's also the argument to be made that, hey, maybe there's this kind of head and shoulders thing going on in here. I wouldn't really be a believer in that until we're actually testing around this 431.50. You'll notice on the Friday session, this is a very faint level. It may not even show up on your screen, but we have something here from this prior neckline of the double top. That level, I can't even see it on my screen, is close to 436.75. And as long as we're above that, I would be open to the idea of Netflix actually doing something like this to produce the equal high back up around 446.50. If we start spending time underneath, that once again starts to unlock more of your head and shoulders type look. 431.50 breakdown brings you to here, and then next stop, the larger double top neckline at 418.50 we were just describing. Tesla, what's going on? Very, very resilient. Given everything that's been going on in the market, the gap down on Thursday, the Friday sell-off, Tesla remains basically in this range almost unchanged. Now, we are threatening a move into the gap as of Friday's close. 275 would be the level that I use. Just remember that this is a very large gap, and you do not need to be the first person in the door. You could wait for a little bit more of a substantial breakdown in here, then scout your lower high, and then look for the gap to close. The worst thing that could happen to you as a short is you jump the gun on it, it turns into a look below and fail, then we target the top end of the range. So that's certainly also a valid long trade. If you notice that the market does something like this, high or low back above 275, target should be the top at 281.75. If neither of those trades make it work for you, right, and that's not your mojo, and you're just looking for a break up and over the top, next target overhead is 287.85 out of Tesla. That also coincides quite nicely with a true range double, so that is target hit. Let's take a look at Google, what's going on over here. This continues to be the maddening chart of them all. You could make the argument for a, again, very pseudo-ish head and shoulders like this. I would really just start tracking the daily lower highs. Right? If you do something like this, you get highs, lower highs, lower highs. As long as we remain underneath that 122, we're kind of building out, in my estimation, the next set and series of lower highs. And the stronger flush is underneath 118.67. Let's call that 65. You guys know me and my pet peeve for round numbers. So underneath that neckline, basically, of that head and shoulders I was just describing, that's your better short indication to get back down towards 116.50. And then back to the daily chart, you'll just remember that way, way better downside outcomes are available underneath that level. So don't try to pick up a couple of pennies here. If there are dollar opportunities down below, just be patient for them, right? The daily downtrend is certainly waning here, and it does look weaker than some of the other stocks we've covered so far in today's episode. Meta, this is still the daily time frame chart. Beautiful break and looking like a retest at that 289.60. Remember that we had 1, 2, 3, 4, 5, 6, almost 7 equal highs all stacked at the same area. Here it is on the hourly time frame chart. I was a player of this on Friday's morning session for a little bit of a move higher here. Thankfully out before the afternoon sell-off took place, but you know, that like I would give this the benefit of the doubt. I would certainly give it the benefit of the doubt. If the broad market itself rebounds in a strong manner into the early stages of this coming week's worth of trade, you probably don't want to be a short in Meta as long as we're above this prior breakout point at 289.60. So bullish consolidation takes place here. Breaks of 297.25 are bullish, and the next overhead target is 307.50. So definitely more of a bull than a bear out of Meta. We will call a spade a spade. If we break down underneath, it's got to be 286.50 with a lower high. Then we will call it look above and fail. And yes, we will target the bottom end of the range at 278.75. Next up is NVIDIA. What's going on with NVDA? This one's kind of an untouchable to me. It's just not really producing any solid outcomes in here. Don't get me wrong. There's lots of money to be made here on the rally if you're quick draw McGraw out of the gates. But if you think about the structure that's at play, we had multiple daily inside bars. Let me just go back there on the daily chart. Like look at the structure that's in play here. Nothing overly indicative of a strong move. Maybe you get the sense of a daily higher low and consolidation over the 421 looks good for eventually an equal high break. But this is kind of a P for patience play. Let the market set up a little bit here in NVIDIA before making the next move. If it is going to turn into a micro double top, you got to get back down underneath with a lower high, that 421 area, right? If this is your double top, it's got to provide that before you start going short. If that does happen, then yeah, we'll trade for downside outcomes. 401 could be on the table. What's going on with Softy? Definitely a balance range building out. So again, more of like a setup phase than a direct instant trade happening on Monday. Perhaps some sort of lower highs back down underneath 338 get interesting back down towards these lows, but you're still contending with the shoulder of the inverted head and shoulders from here at 333.50. So just be open to that idea that, you know, there may not be the easiest downside move. You also technically have a support point here from the open as well as here from the low of the prior day. So a little bit of patience required for better downside out of Softy. And, you know, same thing on the long side, right? Better longs are here, well above 342.25. So some patience out of Microsoft. Let this balance kind of resolve before looking for the next strong indication there. Last but not least, the mini beast is Amazon. This one as well. Again, it's almost like P for patience across the board here in the major mega cap tech cohort, letting these charts set up. Look at Amazon, right? There's your balance range. Once again, strong move up and over that high. The Thursday hammer on Friday. That was a decent little trade, but you know, beyond that, looking for this range to resolve, you got to get into this overhead gap over 131.30 or underneath the top of the previous range from back here. Failing this overhead range, breakdowns of 127 need the lower high, and then once again 123.25 can become a target. We're not there, right? Where are we in relationship to this range? Closer to the midpoint, so we don't really have an edge. P for patience. You know your levels: 131.30, 127. Couple of trade ideas and then you are on your way. BAX for Baxter International is up first on the chopping block, and what you'll see here on the daily time frame is a beautiful bull flag formation. If we can break up and over 45.71, the target is 48. 48.13. This is not the best options trader, so I would recommend just taking shares outright. We also have a bar-to-bar 3-bar play setting up here, and if you take it out to a weekly time frame chart, you also get a bull flag, multiple inside bars on the weekly perspective. Once again, that is the look to your equal high at 48.13. Let's drop it back onto a daily and move through some other stocks which have much better options chains. First up is PYPL for PayPal. PYPL, there we are. What do we see out of this one? Double top in play. This could potentially be a cup and handle, but with the 3-bar bearish play on the Friday session, if we flush these lows, it is the neckline of the double top at 65.82, looking for a flush through the thin structure breakout here to retest support at 63.11. So really, whatever the broad market does, I would favor these individual setups in the direction of the broad market that day. If broad markets are falling off of a cliff, then PayPal downside is probably the better option than BAX Baxter International. Let's take a look at Oracle. Oracle is just kind of a reminder trade that we have this large gap underneath us that doesn't need to fill, but in theory, if we start getting into it, it should be easier rather than more difficult to travel down towards 110.15. That is underneath 114.25. Bearish inverted hammer on the Friday session takes out Thursday's high, closes very weak at the lows of the range. So bears definitely in control. A little bit more enticing now that we also have a big daily lower high from here to here. So Oracle, a little bit of a reminder. And then the last one is going to be on Roblox. I believe this is also a reminder to some extent as well. We've talked about this level in the past and the large overhead gap that exists here. Over 42, looking to trade up towards 46. Technically, the gap closes 45. Actually, my apologies, off by about $1 there. It's not great. Not great, Matt. So over 42, looking for 45 as the gap close. Again, you could wait for an intraday higher low to be a little bit more confident that that move is ultimately going to unfold. And from a range doubling perspective, once again, it kind of brings us in par with kind of some of those levels. 45, 46 would be the upper bound of the expected move there, or measured move, I should say. So that's going to wrap up today's video of the weekly watch list. If you enjoyed it or learned anything new, let me know down below in the comment section or by giving the video a thumbs up. With that said, I hope to see you in the pre-market prep on Monday at 8:15. Wish you all a green trading week.